we can start now. So up to now, we talk about capital structure theories, and we talk about payout policies of companies. And if you remember the big graph, table I always show, what we're trying to do is, based on those decisions, or with those decisions, we are trying to maximize the value of the firm. So this chapter, I will talk a little bit about valuation. So first, as a reminder, the first couple of minutes, 5 minutes, 10 minutes, are very familiar to you, I'm sure. One important thing is, whenever you're trying to price something, whenever you're trying to find the value of something, what we do is we calculate the present value of all the future cash flows, inflows or outflows. So when we think about a stock, we know that in theory, companies can live on forever because they're legal entities. And if they can live on forever, they can make dividend payments forever. So you buy a stock, you start getting some dividends, and at some point you want to sell the stock, and the sale price is determined by the value of all future dividends at that time. So this is like a loop, basically. When you think about selling the stock, you're getting some dividends, plus you're getting the future sale price of the stock, which is based on the value of all dividends thereafter. So what we are doing is, when we are trying to price a stock, which is valuation of a firm, why? Because what is increasing the value of the firm, what we're talking about? When I say maximize value, what am I talking about? Increasing market capitalization, which is increasing stock price. So that's why I'm starting with valuing common stocks, which is the valuation of the firm. So when I am interested in price of a stock, I will calculate the present value of all future dividends. And one little thing before I go into that is something called intrinsic value, which is also called, this is an important concept actually. We talked about this a little bit before, but let's go over it one more time. Suppose that you buy a stock today and you sell the stock next year. So in 1 year, what you're going to get, you're getting one dividend payment, and then you're going to get the sale price when you sell the stock. So these happen at year 1. So you discount those cash flows with the appropriate discount rate, which is R. And this will give you the intrinsic value of the stock. When I say intrinsic value, you can think it as the fair value of the stock. How is it calculated? Let's look at this very simple question. Suppose that an investor buys a share of Bestmark Corporation today and plans to sell it in 1 year. Suppose that you're going to get $3 dividend payments next year, and you're going to sell the stock for $81. And if the discount rate is 12%, what is the intrinsic value? What is the fair price of the stock today? So what do? You say, I'm getting $3 dividend payment, $81 when I sell the stock. I divide it by 1 plus R, because T is equal to 1. So the intrinsic value of the stock should be $75. This is the fair price of the stock. Not the market price. It's the fair price you have in your mind for the stock. Then there's something called expected return. This is also important. This is also called holding period return. This is basically the percentage return you're going to get from any investment. In our example, in the stock example, your expected return for 1 year will be equal to what you're going to get from the stock compared to your initial investment. So I'm getting the dividend payment. I'm selling the stock at price 1. But I'm paying the price of the stock P0 today. So compared to the stock price today, what is my expected return? So, and if you paid attention, you can write this expected return like this. Dividend over price plus P1 minus P0 over P0. Probably they're both familiar. They should be. We talked about payout policy last week. And this part, dividend over price, is the dividend yield. The second part is the capital loss or capital gain. So if you sell the stock at a higher price than the price you paid now, you're going to get a capital gain. If you sell it at a lower price, you're going to get a capital loss. But together, they're going to determine your expected return. So let's look at this example. the same example, but I'm showing the example like this time, okay? Calculate the expected return if the price of the stock is $75 and you expect the stock to sell for $81 next year. You will get $3 dividend payment. What is your expected return? So what do? We have dividend yield, $3 dividend over the stock price, 75, plus the capital gain. You're selling the stock for $81. So together, your expected return will be equal to 12%. So here's the thing. If you buy a stock at the fair value, your expected return will be equal to the discount rate. Remember, in the previous version of the question, I gave you a discount rate to be equal to 12%. That 12% is basically what an equally risky investment would give to you. So if there are two stocks equally risky, they should offer you the same return, right? And if you value those stocks at the, if you discount those stocks value at the discount rate in the economy, the price you calculate should be equal to the market price of the stock. So what I'm trying to say is, I think you will get it better. What happens if the stock price is above 75? What does it mean?
It's lower value.
Low, okay.
More
So
than 12%.
okay.
So you mean the market price, current market price?
Yes. Suppose that the current market price, you calculate the interesting value to be equal to 75, but you open Yahoo Finance and you see that the market price is more than 75. Let's say it is $80. What happens to your expected return? Huh? It will be lower or higher than 12%? Lower. It will be lower than 12%. Why? Because in that case, the stock will be overvalued, and the stock price is higher than the fair value. So you are paying more amount of money to that stock than it's supposed to be valued. Do you understand the relationship now? If a stock is priced at the fair value, the return you get will be equal to the discount rate from an equally risky investment. If you pay more than the fair value, then your expected return will be lower. This is going to be an overvalued stock. So this is something I think very important and something I wanted to point out here. And of course, if the price is below 75, everybody would buy the stock because in your mind, the fair price is 75. So in your mind, it's going to be undervalued. You're going to buy the stock, and your expected return will be higher than 12%. It might also happen. You know, not all the time market prices reflect the true values of companies. Otherwise, nobody would make any trade, right? So based on expectations or the change in value of firms, market price is going to change. It might be higher or lower than the fair price. Okay, now let's move to the valuation again. I'm going to spend some time on dividend discount models, but you already know this from the corporate finance class, so I want to touch base first. So whenever you're trying to calculate the price of a stock, as I said before, you calculate the present value of all the future dividends plus the sale price. At some point, you're going to sell your stock, or you're going to inherit it to your kids, whatever, but someone will sell the stock eventually. So let's look at this example. Current forecasts are for Bestmark Corporation to pay dividends of $3, $3.24, $3.50 over the next 3 years. At the end of 3 years, you anticipate selling your stock at a market price of $94.48. What is the price of the stock given a 12% expected return? What do? If the discount rate is 12%, you know the time horizons for the future dividends. You discount all of them. You're trying to calculate the price today, so you're bringing all the cash flows to today. And at the end of the third year, you're selling the stock for $95, so the price of the stock should be $75. So this, you remember these, right? Okay, simple things, good. And in the dividend discount model, we have 3 special cases. Again, this is a reminder, for you. You might have 0 dividend growth, which means company pays the same amount of dividend all the time. What do you remember from the payout policy chapter? What do you remember about dividends? Is it realistic, zero dividend growth, or not? Which one was the more realistic picture? Having a constant growth of dividends, non-constant growth, or? So what do you remember? Do you remember what is more important for companies, dividend level or dividend changes?
Being stable.
Sticky, right? Is this what you're thinking?
Yes.
Yeah. Okay, this is what he meant. So dividends are sticky, so companies don't like changing dividends that much. So even the zero dividend growth case is not that unrealistic. In the constant growth, dividends amount change by a constant amount all the time, or you might have non-constant growth. So maybe for 1 year, the dividend growth will be 5%, then it's going to be 8%, it might change. So how it affects our calculations? With the zero dividend growth, what happens is the company is not growing and it's not increasing the dividend payment. So every year there will be a fixed dividend payment. So your D1, D2, D3, D infinity, they will be all equal. So, and if when I say companies can pay out dividends forever, this will turn into a perpetuity. So when you want to calculate the price of the stock, what you do is you do dividends over the discount rate, because you have fixed amount of dividend payment forever, perpetuity. And since this is zero growth case, this company is not growing, it means all the income is distributed as dividends. So earnings per share is not changing. All the earnings per share is paid out to stockholders as dividends. So actually, your dividend will be equal to earnings per share, only on this case, that's it. Because there's no growth, all the money is paid out to to stockholders as dividends. So this is the zero dividend growth case. Okay, if you want to go over an example, let's look at this. Suppose this company has an expected growth rate of 0%. The company is not growing. All the money is paid out to shareholders as dividend payments. The stock just received just pay a dividend of 324. If the discount rate is 12%, what is the value of the stock? Easy perpetuity question. Dividend over interest discount rate, 27 should be the price of the stock. Simple, something you already know. You might have constant growth. This is named after Gordon, so it's also called Gordon growth model. So in that case, we assume the company grow at a constant amount every year, and the dividend payments grow at that constant rate at the same time. So this turns into growing perpetuity. So dividend over R minus G will give you the price of the stock. G is the growth rate, R is the discount rate, D1 is the dividend payment. Let's look at this example. What is the value of a stock that expects to pay $3 dividend next year and then increase the dividend at a rate of 8% per year indefinitely? Assume a 12% expected return. Again, what do? We know D1, $3. We know R, 12%. We know G, 8%. Plug the numbers in the formula. The price of the stock should be $75. Again, simple. Any questions, by the way? I know this is a review, so I'm kind of going very fast. But you can stop me anytime if you have any questions. Okay, the last one is the non-constant growth. In that case, you're going to have different amounts of growth in different times for the stock. Let's immediately look at this example. Stock GP has two phases of growth. The first 16% starts at time 0 for 3 years and is followed by 8% thereafter, starting at year 3. We should view the timeline as two separate timelines in the valuation. So in the first 3 years, you have 16% growth, and after the third year, you have 8% growth. So what are we going to do? This part, from the third period to infinity, we have a growing perpetuity. Dividend payments will grow at a constant rate all the time. This part, you have constant growth. So together, discounting all those dividends should give us the price of the stock. So do you remember how to do this from your Finance 101 class? Okay, yes?
You will find the terminal value at the D3,
Mm-hmm.
the time tree,
Or
and
D2.
then
discount rate come to 0.
The point is you have to consider all the dividend payments. So what am I going to do? I'm going to calculate the dividend payments first. So the question says the stock just paid 324, which means D0 is equal to 324, right? Just paid. And if you remember from last week, dividends payments made doesn't affect the value of the stock. Because you're not getting that dividend payment. When you're calculating the price, look at the future cash flows. That's it. Then for 3 years, you're going to grow this dividend payment by 16%. So 324 times 1.16 will give you D1. You're going to grow D2 by 16%. So D2 will be 436. Then the last time, you're going to grow the dividend payment by 16%. So D3 will be equal to 506. Then growth policy changes. Now D4 will grow by only 8%. So you calculate D4 from D3 by growing D3 by 8%. So once you calculate those, you can stop here because you know that after the third period, the growth rate is constant at 8% and it's a perpetuity. So what do? You calculate the P3 price. So if you remember, D4 was 546. You divide it by R minus G. R is 15%. Growth rate after the third period is 8%. So the stock price should be 78 at time 3. Am I interested in stock price at time 3? No, I'm interested in the stock price today. So what am I going to do? I'm going to discount this P3. And also, I shouldn't forget about D1 and D2 and D3. So what do? Let's go back. OK, so I have 1, 2, 3. I have dividend payments of 376. I have 436. I have 506. And at time 4, I have 546. Then I have infinite number of dividend payments. So what did I do? In the first step, I calculated the value of all those dividend payments using this formula. So it gave me $78. Okay, so D4 is checked, 5, 6 to infinity. I consider all of those. Am I done? No. I shouldn't forget about D1, D2, and D3. So what do? I discount D1 by the discount rate. I discount D2 by the discount rate, but now time period is 2. Then I have 506. D3 plus $78, the price you're going to get when you sell the stock at 3. You're discounted with 15% for 3 periods. So this should give you the value of the stock, which is $61. Is this the market price or the intrinsic value? Intrinsic value, again. OK, any questions about this? No? OK, it was like a little review before we go in things that are newer to you. So let's go to the new let's go into new topics. So what are we trying to do? We are trying to calculate the value of firms, projects, or stocks. And there are different ways to value firms. One is liquidation or adjusted asset value. The second one is public comparables or multiples approach. We're going to look at financial ratios of different companies. Then the last one is discounted cash flow methods. We talk about discounted cash flow a little bit, but now I'm going to introduce you new methods. One is adjusted present value. The other one is flow to equity. The last one is weighted average cost of capital. Okay? And that will be all for today. This is what we're going to do today. OK, let's start with the difference between book value and market value, something you should know and should remember. Do you remember the difference between these two? Where do you find the book value of a company? When I say book value of company, I'm talking about book value of equity, which is where?
Balance sheet.
In the balance sheet. Perfect. And market value?
Yahoo.
OK, yeah, OK, yeah, Yahoo, Google, MSN, fine, Bloomberg, OK, many different places. And market value of equity is basically market capitalization, right? Price times the numbers of shares outstanding. Do you remember the difference between these two? Or let me ask you, which one is generally bigger, market value or book value? Market value, okay. Why?
Because it looks the future, the cash flows, we also look for them. But book value is the snapshot of the company and before.
In book value, you look to the front, as Fatih Terim says, not the back. Okay, in the book value, it is historical value, right? So the historical value of the stock sales. In the market value, you look at the future prospects of the company. So market price has information about the past, current, and future, right? And because of different expectations, of course, market value fluctuates. Okay, so let me give you an example. When you look at FedEx, in May 2010, book value of FedEx's equity was $13 million or something. So if you calculate book value per share, what do? You divide this amount by numbers of shares outstanding. It was $46, $47 for FedEx. When you look at the stock price, which is the market value, stock price was 83. As you can see, there might be a huge gap between market value and book value. And we're going to talk about the reasons why we see it in a little bit. And market value is determined by investors who are thinking about buying the company. So they look at everything. When I say liquidation value, it's basically the value of the firm after all the creditors are paid off. So in this case, what we do is, when you look at the balance sheet, equity is equal to assets minus liabilities. But for the liquidation value, we are looking at adjusted assets, which takes into the market value of the assets. So market value of debt, market value of equity will give you the adjusted assets. So it is a little bit better than looking at the book value. So this is how much the company would sell after all the creditors are paid off. The difference between a firm's market value or its liquidation or book value is called going concern value. And as I said, generally market value is higher than the book value. Why is it the case? There are three important factors. One is extra earning power, which is a company who has assets would probably use those assets better than a potential buyer. They're more productive and efficient using those assets. So that might be the one reason. So the actual value of those assets is higher for the existent business, not the buyer of the company. The second one is intangible assets. It's really very difficult to value intangible assets like R&D. So for drug companies, R&D expenses value is really high, for instance. And it might be difficult to value those assets in the market correctly. So that might be one reason why market value is different than book value. And the last one, and probably the most important one, is value of future investments. So the market, when the market looks at a company, investors are considering the growth opportunities. That's why you're differentiating between growth companies or mature companies, right? You think about their investment opportunities. For mature companies, there's not much room for new investments, but for growth companies, there is. So the market values this differently. That's why we see a difference between market value and book value. So this is liquidation or adjusted assets methods. Again, what you do, you look at the book value, you look at the liquidation value. The second one is comparables approach. You're really comparing companies, basically, with different companies. You can do it for public companies. All those ratios should be known publicly. This is also called multiples approach. And most common multiples that analysts and investors use are price to earnings. So this is price over earnings per share, basically. Assets over sales, or market to book. When I say market to book, this is market value of equity over book value of equity. So let's look at this example. This is market to book value ratios of those companies. And these are the competitors. And here I have price to earnings ratio of companies and their competitors. So I want you to focus on Johnson & Johnson. So the market to book value for this company is 3, and for competitors it's also 3. So it's just at the competitor level. And price to earnings ratio is 11.8 for Johnson & Johnson. For competitors, it's 10.5. So what you do in those comparables approach, you say, okay, earnings per share for Johnson & Johnson is 486. So if earnings per share for Johnson & Johnson is 486 and for competitors it is 10.5, I multiply these two, earnings per share times the PE ratio. So it will give you the price of the stock, right? So let me just quickly write it. So price over earnings per share. So you look at the earnings per share for Johnson & Johnson, and then you say this ratio is 10.5 for the competitors. You multiply these two, it gives you the price of Johnson & Johnson, which is equal to what? Do you have a number? 10.5 times 4.86. Huh? 51? Okay. So you say, okay, I'm expecting Johnson & Johnson stock price to be around 51, looking at PE ratio. Or you can look at market to book ratio. You look at the book value per share of Johnson from the balance sheet. It is 19.19. So this is book value of equity over numbers of shares outstanding. Then you say, okay, look at the competitors. Market to book ratio is 3. So multiply 19.19 by 3. It will give you something around what, 57? 19.19 times 3. 57 point something. Then you say the stock price for Johnson & Johnson should be 57. If you're interested in the real stock price of Johnson & Johnson, it was 58. So as you can see, some multiples are doing a better job to estimate the value of the stock. So what do? You look at the competitors, you look at the ratio of your company, and then try to have an understanding of the price. Again, you're trying to value the company. If you are interested in which ratios are used most commonly by the analyst, it is price PE ratio. You have enterprise value over EBITDA. You have residual income, how much income you generate after you pay your capital providers. You have enterprise value over, I think this was EBITDA growth. I have it in the slides. Discounted cash flow analysis, blah, blah, blah. So these are really used by analysts. Okay, so these are not unrealistic things we teach in the class. Especially PE ratio is used very widely, but I'm going to show you some problems with it in a second. If you want to know what kind of multiples are used, I actually summarize it in this slide. I'm not going to go over them one by one. You don't have to memorize anything. But as I said, probably the most important one is the PE ratio, which is price over earnings per share, which is important to keep in mind. Analysts look at enterprise value over EBITDA a lot. Enterprise value is market cap plus debt, basically, over EBITDA. These are important. Again, you don't have to memorize anything, and you can read the ratio very easily. I mean, when I give you this, it is enterprise value over sales. So you're going to find enterprise value from balance sheet, and market cap should come from market information, of course. Sales come from income statement. So it's not very, very difficult. But let me show you things over examples to have a better understanding of things. So let's look at this company, Greens Health. It's a privately owned supermarket chain. It's an expected earnings are of 20 million per year. And sales are 205 million, total assets are 80 million. In a proposed IPO, Greens will issue 10 million shares, so forecasted earnings per share is $2 per share. The firm is all equity. So you are interested in finding some value for this company, right? This is a private company. How are you going to value this company? There's no stock price, nothing. The best thing to do is look at the comparable firms. Again, this is what investment bankers will do to have an understanding about the value of the company. So let's write down this information because we're going to forget. Okay. So I have earnings 20 million, sales 205, total assets 80 million, earnings per share is $2. It's basically earnings over 10 million stock, right? That's it. So let's look at the comparables. So suppose that this company has two competitors. One is Once, the other one is Safeway. And these are public companies, so you know about their PE ratio. So what are you going to do? You're going to look at their PE ratio. It's 18 for Once, 19 for Safeway. You take an average. It's 18.5. So what do? You're going to multiply this by 2. Your earnings per share is 2, right? Just like what we did for Johnson & Johnson. PE ratio is, from PE ratio, you're trying to figure out the price for the stock. Your earnings per share is 2. The PE ratio in the industry is 18.5 on average. So implied stock price for your company should be $37. Is this clear? Just like what we did in Johnson & Johnson. Look at the industry PE ratio, multiply it with your earnings per share, so you're going to get some price. It's 37. Okay, suppose that that's not enough. You look at price over sales. And for that one, Once have 0.24 PS ratio. Safeway has 0.38. So what do? You take the average. It is 0.31. So since this is price over sales, to find price, which information do you need? Sales. What is sales? It was 205. So multiply 0.31 with 205. It will give you a firm value or stock price of $63 million. And this is important. Like sometimes we don't use PE ratio because, especially for instance, technology companies, sales might be a better place to look at. So depending on the industry you're looking at, different ratios might be more valuable. Do you have a question?
Yes, like sales is in the millions and
Yes.
it will give like 63 million. Like what if?
Oh, this is for firm value. You just divide it by 10 million. But very good question. For the stock price, if you divide by 10 million, then it's going to be stock price, right? Okay. The last one is the market to book ratio. Again, you look at the market to book ratio for Once and Safeway, which is way different. But you take the average for 45. You know the book value of this firm, which was 80, right? Book value. This is all equity, so all assets are in equity. So you can multiply this with 80. So you're going to get 356 million for the firm value. So what did you get from here? The numbers changed from 37 to 356, a huge range. So there are some problems with the multiples approach. Another problem is when you're making comparisons, you don't know, you don't consider the leverage structure of companies. So I'm talking about firm value, but if a company has lots of leverage, you know, like firm value is the actual value of all the assets. So there's debt plus equity. So you cannot compare a company without any debt to a company with lots of debt. So those ratios will fail when you're trying to compare those companies. And this might be the case here. Suppose that Greens carried 114 million of debt, so it's not an old equity anymore. If it is the case and the equity value is 250, then the true value of the firm will jump to 364. So the different capital structure of companies will also affect your comparisons a lot. So that's another problem. One more problem. You shouldn't compare companies at different stages. You cannot compare a growth firm to a mature firm's ratio. So you should be very picky about what kind of competitors you're looking at. You don't know the cash flow structure of the companies, right? Different cash flows will create different risk, different everything. And as I said, risk is probably the most important thing. So you should be able to compare companies with equal risk, which is a very difficult task. But it is still done. Not one method is used to value a company. This is a very important decision. Why is it so important to value companies? Because you're trying to find mispriced securities, right? If you can calculate the fair price of a stock, then you would be the king. You can find undervalued stocks, make lots of money, and be rich, and live the rest of your life very happily and comfortably. So we are trying to find the correct price of firms, which is very, very difficult. This is another problem. And the last problem is you don't know the true, especially for the earnings per share part. So I said PE ratio is used a lot by the analysts, but maybe the price and earnings relationship is way different than you think. So suppose that you have a regression like this. So you multiply earnings per share with 12, you add $90. This is the true price. This is the true relationship between price and earnings per share. So in that case, what are you going to do? If you calculate the price for bonds, its price will be actually 18. For greens, it's going to be actually, with earnings per share, it's going to be 33. So as you can see, it's going to affect your valuation estimate of companies. What is important is, let's just look at this two summary slides, then I'm going to go back to two more examples. So what is important is, when you're choosing comparables, the first step is finding good matches. So finding the good industry competitor is important. For that, of course, you're going to look at their indices. And then once you know it, then you need to figure out which ratios are better to look at. Okay? You should look at the annual reports, the investment decisions of companies, and you should pick the ones which are most similar to yours. And also you need to look at the customers, sales, revenues, costs, and everything. Then maybe instead of using averages, you can use medians. If there are externalities in those ratios, it might be better to look at the median, as you remember from statistics classes. And after that, you can use the multiples approach. It's easy to use. It's very easy to explain, right? Think about the Johnson & Johnson example. You got it in 1 second. You don't need any finance information or anything. It was very quick. But disadvantages are, I always say, when you're dealing with accounting numbers, there are always problems with it, because you can use accounting tricks to boost up your numbers and things. Also, looking at multiples, it ignores risk characteristics, cash flow characteristics of the firms. And most importantly, capital structure. You cannot compare apples to oranges. You should compare companies with similar capital structure, which is also not a very good, not a very easy task. So the last two things I'm gonna show you is, I told you two most commonly used ratios were enterprise value to sales. The other one is the PE ratio. So I just wanted to give you two examples on this. And then we're going to move to discounted cash flow analysis. So for enterprise value to sales, it is really important to compare companies with similar operating margins. So for Home Depot, for instance, we are looking at enterprise over sales, enterprise over EBITDA, price to earnings. And as you can see, there's a huge, range of numbers you see from your competitors. And when you apply enterprise over sales multiple, as you can see, you expect the stock price to range from anywhere from $4 to $60. So that's a problem. Even if you say, okay, Home Depot, you can compare it with Lowe's, it's not a very easy task to do. So you should be well aware of what kind of companies you're looking at. The problem with PE ratio, it is also used a lot by analysts. More than 60% of analysts use it, if you remember the graph. So with the PE ratio, one problem is with the capital structure. So for here, I wanted to show you how PE is affected by different capital structure. So here you have debt to assets. Here you have PE ratios for companies. And as you can see, as you increase leverage, your PE ratio is decreasing, and PE ratio increases as leverage increases. So from here to here, as you can move, PE ratio will increase. So with different capital structure, you will have very different numbers for PE ratios. Again, the takeaway, try to compare companies with similar capital structure. So as you can see, it's almost impossible to find a real competitor, right? Same risk, same cash flows, same operating profit margins, same capital structures, then the comparables approach will give you a meaningful number. The second problem with PE ratio is it doesn't separate operating and non-operating performance. So for instance, if your company has lots of excess cash, then PE ratio will be very high. But having excess cash might not be a good thing. And it will affect your calculations, and it will affect the valuation of the firm in an incorrect way, let's say. And another one is if you have one-time non-operating gains, like you're reducing your restructuring costs a lot, for instance, for one period, then it's going to increase your earnings temporarily. Accounting stuff affects the PE ratio, as you can see. And in that case, again, you're going to misvalue the company. So that's another problem we might see with the comparables. So up to now, what did we do? We look at the liquidation value. Very important thing is the difference between market value and book value. And we said the difference raises for different reasons, like extra earning power. The existing business uses as assets better than a potential buyer of company. We said it's very difficult to value intangible assets like R&D, patents, copyrights. And the third one is it is very difficult to value future growth opportunities of companies. But the market considers all of these, and thanks to more transparency in the markets, we see more and more information, and we are kind of doing a better job valuing companies. Then we said multiples approach is used a lot by analysts and by investors, and for that we need to choose correct competitors. We should look at their ratios very carefully. We should read the footnotes and everything, try to find a competitor with similar risks, similar capital structure, similar cash flows. Then you can have an estimation of fair value of the company. The last thing, and what we're going to spend, how we're going to spend the rest of the class, is discounted cash flow approach. So all those discounted cash flow approaches, what we're going to do, we are going to estimate the cash flows, and we're going to find the correct discount rate, which is also not very easy to do. And then we are going to use one of those methods. We might use weighted average cost of capital, adjusted present value, flow of the equity, and I added one more, which is a newer one, capital cash flow method. So let's take a 10-minute break and then continue afterwards.